Good morning, good morning. Well, the word good on a morning like today is relative. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 13th of October. I'm JD Durkin. Opening bell rung here on the floor moments ago by the New York Islanders here in town to celebrate opening night for their club's historic 50th anniversary. The New York Islanders famously won 4 straight Stanley Cups in the early 1980s. And in fact, that's the last time that the Social Security cost of living adjustment was as high as it is now. We learned earlier this morning that the COLA will be 8.7%, the fourth highest since the program began in 1975. A pay raise, if you will, of sorts at least, for millions of Americans who qualify. Of course, determining the COLA for next year is based on inflation data from this year, and we did also get that this morning. And it wasn't pretty. On an annual basis, inflation was up 8.2%, hotter than the Street's expectations. It is weighing on investor sentiment on the markets now as well to get a sense on where things are. The first few minutes into this trading session, pre-market was pointing to a negative open, and a big one at that. And that is the case here on the floor. Similar story for the Dow, the S&P, and the NASDAQ, all down here. Notably, the Dow is down 1.8% at the moment. We'll continue to follow the indexes and all the red tape across the board. With that, let's turn our attention to what is on tap for this morning's show. We'll be breaking down the latest inflation data and what it will mean for investors today. And it will mean a lot, as we already see a moment or two into the session. Plus, Delta earnings and what it says about Americans' willingness to travel. A lot of revenge travel out there. People want to get their passports, get stamps in their passports, and get back out there after not being able to do so for a couple of years. For more insights into these stories and much more, we bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, you're the only person to help calm the volatile seas right now. So help me better understand, what is your reaction to the scorching hot CPI numbers we got out at 8:30 today?
Well, I'll tell you what, if I'm the life vest in this sea of inflation fear, then we're in a lot of trouble. Because I'm not the man to steer you out, I'm sure, JD. But you're right, these were much harder than expected numbers. Not so much at the headline level, 8.2% was just ahead of street forecasts and actually slowed a bit from the levels that we saw in the month of August. But what was worrying everyone was the spike that we saw in core consumer prices. Now, put that into plain English. The Fed prefers to look at the core measure of inflation because it strips out significantly volatile components like food and energy that interest rate hikes simply don't have much of an impact on. They're far more affected by supply and demand than they are on cost. So we like to look at the core number, and that spiked to an annualized rate of 6.6%. On a monthly basis, it was over double the street consensus forecast. So JD, this illustrates what we spoke about yesterday, and that is where producer price inflation was faster than expected, largely because of what we can see as embedded costs in the services sector. That is really why we are seeing the spike in core consumer prices, and it unfortunately cements the Fed's singular fear that these inflation dynamics are going to find themselves sticking into larger and broader portions of the US economy, fueled in part by rises in average earnings and paychecks and the tight labor market, and therefore likely to remain for a longer period of time. In other words, if they are embedded to such a degree that they become consistent rollover predictions in terms of how we see inflation going forward, they're much harder to pull back in terms of from the Fed's rate hike reaction standpoint. And therefore, the Fed feels it will need to get more aggressive and hold rates at a higher rate for longer as a result. And that's exactly what we're seeing in the marketplace this morning.
You mentioned embedded costs in the services sector. What specifically do we know for people that hear that and maybe see in headlines? Can you help us maybe try and break it down a little bit more, Martin? Like, at least what is an example of what some of those costs would have been to contribute to the PPI data, which helps at least a little bit explain or set the scene for what we have today?
Largely and ultimately, it's going to be in the labor cost construction, JD. Effectively, it's just much more expensive to bring a new person on, to hold them in place in a job when there are so many more options for people to execute and therefore increase their paychecks as a result. So that seems to me the biggest component of that embedded services levels pressures. But what we are also seeing is just spikes and upticks in heretofore unknown parts of the economy or unexplained parts of the economy. And by unexplained, I mean the fact that they are spiking isn't necessarily something that people predicted. So whilst we saw declines in clothing prices as a result of the discounting that many of us experienced over the summertime as big companies got rid of inventory, and as we saw gas prices tumble as a result of the decline in global oil prices, we also saw upticks in things like vehicle insurance costs, which was a bit extraordinary, with companies charging us more heading into the hurricane season. New car costs were also higher. That is a result of a few issues. Firstly, demand. Secondly, supply chain disruption, which makes putting cars together even more expensive than they typically are. And again, labor costs, which are rising in a significant way. The US dollar index, of course, is also rising. The dollar is on a strength that we haven't seen in about 2 decades. And that, of course, also adds to the wage pressures that we're seeing too. So collectively, those things are finding their way into the economy and staying there. It's much more difficult to cut someone's pay than it is to increase it. So pulling back on those wage increases and therefore pulling back on salaries, it's not something that we're likely to see anytime soon, even if the Fed were to continue on its inflation fight and its rate hike path.
Yeah, taking a look here at the CPI figures from today, price increases over the last year. I mean, the numbers are jarring, Martin, to say the least. Fuel oil up 58%, gas utilities 33%, food at home up 13%, medical care up 6%, used cars up 7.2%. Everywhere you look, these numbers are up significantly. What do these figures tell you? And I wonder if there's any of these particular sectors that may be a bit more troubling to you than others.
The inelastic ones, JD, are the ones that I often look at because, as is often said, or at least it used to be said prior to the pandemic, you can't drive halfway to work. In other words, if you are spending a particular amount on fuel costs in any given month, that level of spending is going to stay consistent throughout the year because you don't really change your day-to-day habits that much as a result of the demands of work and keeping your family warm and all those other things. So economists refer to that as inelastic spending in the sense that it doesn't change that much on a monthly basis and therefore is consistent and a little bit easier to forecast. So when I see those spending levels remaining in place and therefore and in this case accelerating on a year-on-year basis, it does tell me that these inflation pressures are here and are going to remain for a very long time.
You know, sometimes I ask you questions. Most of the time I ask you questions because I legitimately don't know what your answer is going to be. This next question is not one of those. Martin,
Okay.
will this keep the Fed firmly entrenched on its tightening plan?
We'll put it this way. If they were entrenched up to their ankles, they're now into their knees with respect to their placement on the rate hike path between now and the end of the year. There's about a 96% chance of a 75 basis point rate hike in November. That would take the Fed funds rate up to around that 4 to 4.25% rate. Then we'll probably get another 75 basis point rate hike in December, at least according to the CME Group's Fed Watch. And what we're seeing now, JD, as a result of a jump in 2-year bond yields, we're seeing the likelihood of a Fed funds rate topping out at 5% in the first quarter of next year. That's more than 50 basis points higher than you and I spoke about just a couple of weeks ago. So it does suggest that the market is now and perhaps finally reading the message that the Fed has been trying to express for a number of weeks now, that irrespective of the impact on the economy, they are going to continue to use their toolbox to fight this inflation surge. And therefore, we are very likely to get to that 5% level, even if we tip into recession in the first or second quarter of next year. That was expressed in the minutes of the September policy meeting, JD, that came out yesterday in the afternoon and clipped gains for US stocks. And I think the hawkish tone of those minutes set against the hotter than expected CPI data today is why we're seeing that jump in rate expectations and also the big pullback in stocks, certainly in tech, but across the board altogether.
Martin, any silver lining? Anything, even like a very light shade of silver?
It's hard to find on a day like this, JD. The one thing I would say is that there is an arithmetic certainty that inflation is going to slow. And by that, I mean, when we look at these year-on-year increases, it has to be remembered that we're measuring price rises, for example, in the month of October of this year against the month of October of last year. And because we did see a decline in global oil prices and indeed a decline in industrial inputs from this year compared to last year. The arithmetic of the measurement is going to mean a slowdown in the headline rate. But that doesn't mean that inflation is going to fall quickly or in a significant enough manner for the Fed to change its mind. It does mean that the trend is moving ever slowly downward, but ever slowly is the key adjective there because it's simply far stickier than we had first assumed. So if you're going to ask me to pull out a silver lining in this thorn bush, I'm going to say that yes, we will begin to slow into the end of the year and indeed beyond. But the timing between now and when we approach the Fed's 2% CPI forecast could be more than a year and potentially more than 2 years, given the fact that we are seeing some of these costs embedded into the economy, and therefore they're far more difficult to pull out as a result.
You know, before we move on here, I just wanted to kind of update people who are watching about the current state of where the indexes are. And I'm reminded of comments from B of A and of others about how important a potential buy level would be for the S&P 500 if and when it reached 3,600. That was a couple of weeks ago, Martin. Right now, it's down to 3,500. As we speak, the S&P is down on the morning 1.9% to just a hair over 3,500. The tech-heavy NASDAQ is down 2.6%. You can imagine the big names in tech that are helping drag down that index. The Dow is down 1.5%, so we knew that it would be a big morning of red tape after the CPI figures. This is just the sort of broadcast, Martin, I'm sure you understand as the hour or so rolls along. I think it's important to kind of give people a bit of an update with regards to where we stand. Are there anything there, before we move on those numbers, is that a surprise to you, or were you sitting there at 8:45 this morning largely expecting that would be the tail of the tape 15 minutes into trading?
I'm a little bit surprised by the market reaction to some degree because I thought that the mixed messages that we were going to get from inflation would probably not provide the clarity that the market was looking for on interest rate hikes and indeed the path of inflation. I felt that the fact that we were seeing moderation on an annualized basis on the headline rate was going to be strong enough to maybe hold off some of the worst of the bears when they saw the spike in core CPI, but I was proven wrong, obviously, as a result of what we're seeing here. But what you're describing, JD, on the S&P 500 at the very least is interesting to me because I think if my arithmetic is right, we're down close to 25% on the year on the broadest benchmark of US shares. We haven't had a year-on-year decline of 20% more than 3 times over the past 50 years. So if we get this is going to be one of the worst years for US stocks in most of our lifetime. And that is really something to be said, considering that 2 of those prints were in and around the global financial crisis. So what we're seeing now, I think, is incredibly significant. It's an echo, if you will, of all of the disruption from the COVID pandemic in 2020, the central bank response to it, and maybe some market miscalculation as to the changes that we're seeing in consumer patterns, in labor patterns, and indeed in inflation patterns as a result.
Martin, obviously we got earnings. We'll talk Delta in just a second, but I think with regards to the current slate of the conversation that we're having right now, I want to give you the opportunity to address anything specifically. I didn't ask you to help kind of set expectations perhaps for viewers with regards to just how volatile today's session could be, or perhaps even into tomorrow. Anything top of mind for you that maybe I didn't address?
No, I think you hit it most, JD, to be perfectly honest. I think the one thing I would say is that the bank earnings that we are expecting tomorrow might not provide the clarity that we're looking for either, simply because they have had such a shakeup as a result of the disruption that we saw in financial markets over the summertime. So even though they're big names and big numbers, the market's going to react significantly to them, even if they don't give us the full picture of the third quarter earnings season and indeed what we can expect for corporate profit going into the end of the year. I'm not saying by any means the Q3 earnings are going to be solid. They're only going to be up about 4.1%. And when you strip away the energy sector, they're actually going to decline from the same period last year. We will see modest gains over the final 3 months of the year, but a lot is going to depend on the forward outlook from some of the largest companies, particularly in the tech sector, and the impact of the strength in the US dollar, which, as we know, is a headwind to both overseas revenues and the repatriation of earnings. So that is where you see that connective tissue between the Fed reaction function and the way that the market is going to perform as a result. If the Fed is going to signal and hold firm on its commitment to rate hikes, the dollar is going to rise against its global peers. That's going to add as a headwind to corporate profitability. So therefore, even if we get stronger than expected earnings, the outlook is going to be affected by Fed policy, both directly and indirectly. Therefore, if we are looking for an escape hatch from solid third quarter and indeed fourth quarter earnings outlooks, I don't think we're going to find it this time around.
There are 26 days between now and the midterms. Martin, not that this is a politics show, but I can't imagine this is really the sort of news the White House wants. Fed independence is incredibly important. There is a history of presidents or chiefs of staff inappropriately pressuring Fed officials. We saw that with Nixon. We saw that with Reagan's chief of staff pressuring Paul Volcker before Reagan's reelection. We found out many years later when Paul Volcker wrote that. This is not, we have no idea what the relationship looks like between necessarily this White House and this Fed. We know that independence of the institution would be incredibly important to someone in Jay Powell's position, but my goodness, politically speaking, for the Democrats and for the president, this is probably not the sort of conversation I'd imagine you really want 26 days to go, right?
No, I think you're absolutely right about that. It probably explains why the Democrats have been so active over the summertime in getting forth legislation that they can use on the stump heading into those midterms, particularly when they name one of the pieces of legislation, the Inflation Reduction Act. They understand how this is going to play amongst the electorate, and they want to make sure that they have policies that people will see as being designed to fight this kind of inflation forecast. I think the fact that Social Security is going to increase benefits to such a degree that it will offset most of this year's inflation increases also a positive. The decisions the administration has taken on tapping the SPR in terms of attempting to try to bring down global oil prices and therefore prices at the gas pump has also been a positive. But I do believe that you're absolutely right, JD. When people are looking at the levels of value in their 401k as a result of, indeed, one of the steepest declines in stocks in decades, that's a hard message to fight against when your political rivals are telling you or telling the electorate that most of these declines are the result of policy mistakes. So it sets up for an interesting debate, really, heading into these midterms. And it's anyone's guess who's going to win the argument.
I mean, at least the cost of living adjustment gives the White House something to say when they come out, you know, for the daily White House press briefings, right? I mean, they can try and sugarcoat what's otherwise a lot of disastrous headlines to say, well, hey, if you are a Social Security recipient among these 66 to 70 million or so, it's about 20% of the population, you're going to get an average boost of $144 a month. That's about what the 8.7% figure equates to. Martin, do you expect that messaging to at least be there to say, pay no attention to everything that's happening in the macro side, but Social Security recipients, there is at least a little bit of good news, right? I mean, I would imagine the White House and their allies to highlight that on a day like today. Is that kind of a silver lining?
I would say so. I think you're right in pointing that out, JD, because I was struck by some of the messaging inside the statement from the Social Security Administration this morning, because they were so keen to talk about the decline in Medicare costs. And that's something that the administration touted just a few weeks ago. So there's a syncing up of that message for sure from the Democrats' point of view. And I think the fact that they are using the COLA increase as a launch pad for portions of that message is extremely important, and I think speaks to your point that they're going to try to use this in some way to assuage concerns about the cost of living increase by saying, we're providing you with as much comfort that we possibly can, even though we understand these times are difficult. And I think, JD, this government, much like many other governments around the world, are going to point to global situations. In other words, the disruption that we're seeing in markets and economies all over the world as being the larger reason, as opposed to policy mistakes domestically. We understand that this is the case, obviously, in the United Kingdom. They're doing it in Europe and China and Japan and everywhere else. Essentially, to put it mildly, government officials and leaders are saying it's not my fault. Look what's happening to the global economy. This is a recession that none of us can control or predict, and therefore we're doing the best we can. It's not the most compelling message, but it might be one that at least resonates to people who are seeing their cost of living increase without necessarily a great explanation as to why.
Yeah, again, well, you know, it's worth reminding that this is going to be the highest cost of living increase officially since 1981. If you look back at that 79, 80, 81 era, the numbers, of course, were very high. Inflation was very high back then. The program started in 1975. This is a historic increase for sure at 8.7%. It is largely in line with what we saw. But again, the reason you have a number that high is contingent on the September CPI data. There's also a lot of questions about which parts of the data they look at. Does that really
Yeah.
directly impact seniors or oftentimes retirees who receive
Yeah.
Social Security? Bit of a different conversation for a different day. It's not a perfect system for the COLA, but it is a noteworthy one. And I'll be interested to see what the White House messaging looks like on that as they try and accrue any type of win, Martin, or perceived win between now and the next 26 days. And I think, look, the White House does have objective wins. Yeah, go ahead. What do you got?
No, JD, I was going to say, I think you're absolutely right. I was just wondering whether the cost of living increase from 1981 was the last time that the New York Islanders won a Stanley Cup. You can probably tell me.
It's about right. I do think the Islanders won the next year in '82 as well, if I'm not
There we
mistaken.
go.
They did win 4 in a row. I knew the era was above. That shows you how long it's been, though, right? Hey, the Islanders
There
are
you
here
go.
today because they're a club for 50 years. They were dominant 40 years ago. That's the last time that you had the cost of living adjustment, more or less, in line with where it is now. It's a sign of the times, unfortunately, for people who remember. We also had a lot of those pressures in the so-called Volcker shock era as well. You and I could talk about this stuff all day, and rightfully so. We give it a lot of attention. Let's talk a little bit more of a nuanced story here. To the skies we go. Travel has recovered to some degree. What do we learn from Delta as they post another profit in the last quarter? I know it wasn't a pure beat, but there seems to be a lot to be optimistic about in the travel space specifically, right?
Yeah, no question about it. We're seeing one of the biggest travel surges really since the pandemic, and levels of increase that really rival what we saw prior to that as well. And it was reflected in Delta earnings this morning. They had record revenues, JD, of just under 12.9 billion, up a little bit more than 40% over the same period last year, and that's really quite something. Again, there's issues about capacity and whether or not they're going to bring some of it up heading into the end of the year. But Delta, nonetheless, said they're probably going to post a bottom line of between $1 and $1.25 per share for the final 3 months of this year. That was well ahead of street forecasts. And it sent the stock firmly higher in pre-market trading. Of course, it got caught in the downdraft of everything else following that inflation release. But the numbers were definitely solid and really do reflect an industry that's trying its best to climb out of an incredibly difficult situation with a lot of government support, it has to be said. But nonetheless, Delta kind of reflects, I think, what we're likely to expect from carriers heading into this third quarter earnings season. That's solid demand, improving margins, reasonably solid outlooks, and ultimately some support to share prices that have been beaten down for much of the year.
Martin, you don't have to give me any of the personal details. Did you or your family, did you have any revenge travel booked, as it's called? That's the idea that after COVID or during COVID, we're all stuck at home. And then afterwards, we all grew frustrated and said, all right, I'm getting my revenge. I'm booking that big trip that I want to go on. I'm going to take my family to. Did you give yourself anything like that?
Yeah, to be honest with you, no. The only big travel was back and forth to the United Kingdom, and that was more out of necessity than luxury, it has to be said. I think based on where I am at the moment, there's not a great need for the kind of travel that most people would like to experience, simply because I'm fortunate enough to enjoy sunshine and warm weather pretty much all year round. But absolutely, I think revenge travel, experience travel, maybe is the word that Bastian, the Delta CEO, would prefer to use. He is eliciting and expressing some of the remarks that we've seen with respect to spending in this economy, particularly from young people for a long time. And that's the desire to spend on experiences rather than accumulating goods. It's quite a change and a differentiation in consumer spending patterns in the U.S. economy. And I think it's one that's going to continue.
I like experience travel. I mean, I like the phrase experience travel. And I admit I've given myself several experience travel opportunities. I did
There you go.
Switzerland not too long ago. My mother and I were down in Aruba not all that long ago. And there are advantages, not many, but at least perceived advantages to the strength of the U.S. dollar. Of course, if you are an American traveling abroad, your dollar will likely go further. Not that it's good for the overall economic system or health here at home or abroad, different conversation again. But hey, if you're going to go and you're going to travel, maybe there's a place overseas you'd gone for some years, you go and you say, hey, things seem to be a little bit cheaper. My dollar goes a little further. That's part of the issue happening there with the strength of the U.S. dollar, regardless. Do we learn more about hiring efforts, I wonder, from Delta? I'm reminded of all these controversies back during the COVID era of layoffs and sort of awkwardly forced early retirements. I got to imagine as demand has picked back up, so too need to be efforts to hire, right?
Yes, absolutely. And I think this is why the capacity issue remains the biggest question for carriers, even as they talk about that robust demand. All of us who have traveled recently will tell you that the flights have been booked The lines have been long, and the people who are assisting us to get onto the plane and during the flight are under tremendous pressure as a result of these fully stacked planes. And JD, it unfortunately has to be said, some really unruly and escalatingly unruly behavior from passengers at the same time. And I say that because it speaks to the cost and the difficulty in keeping staff in working in an industry that really is under constant and consistent pressure to generate profitability and keep things moving. I mean, if you are in and around an airport on any given day, on really any time of the year, you'll know how busy it is, and you will see how under pressure airport and airline staff are as a result. Companies have a difficult time getting cabin crew and an even more difficult time, JD, getting qualified pilots in. They have to pay more to do so. And as a result, that of course puts downward pressure on margins. So that is something that I'm certain will be part of the conversations in the conference call with analysts today and likely going forward, because whilst the profitability, whilst the potential for that travel demand is extremely optimistic, airlines probably do need to increase capacity in order to meet it, but to do so will likely put downward pressure on margins because they have to pay a lot more than they used to have to pay to keep staff involved.
Yeah, of course, we'll be hearing from American next week. Any reason to think Delta is an outlier here, or these largely will be, you think, in line with expectations for a lot of big names in the space as well?
Yeah, I suspect it'll be similar, JD. American updated us earlier this week on what they anticipate for revenue growth over this quarter, and it's pretty significant. And it's solid going into the final months of the year as well. They're effectively reflecting what Delta had said today and what other carriers have been hinting at for a long time, is that the travel demand boost is going to lift all boats, if you will, to mix metaphors in the airline industry. But again, those capacity questions are going to remain, and ultimately American is going to have to sort of thread the needle between ensuring that they can meet the demand without raising capacity to such a degree that they pressure margins going forward.
A rising air current lifts all airplanes, perhaps. I don't know.
That's
I'll
much
workshop
better.
it, but I it's something like it's not perfect. I'll work on it tomorrow. I'll bring it back tomorrow. Okay, time now for our rapid fire section already. If you could believe it here, my friend, a handful of questions to get your take on. First up, let's head back overseas. You were talking about it a minute ago. Could we see a U-turn, Martin, on the UK tax plan?
That was the headline this morning, JD, that actually gave U.S. stocks a boost, which I have to confess I thought was a little bit silly. But nonetheless, the suggestion is that the government, which only a couple of weeks ago said they were going to cut the top rate of tax for the highest earners in the country, is now looking at potentially not only not doing that, but actually raising corporate taxes in order to fund some of its broader ambitions to spark growth in the fifth biggest economy in the world and to pay for, indeed, some of the costs required to put a cap on energy prices as a result of the energy crisis in Europe and elsewhere heading into the winter months. This is a government that's less than a month old, JD, and this could be the second significant U-turn in about 4 weeks if it turns out to be true, and it has been reported by virtually all of the media outlets in the UK. I'll be terribly surprised if Liz Truss, the new Prime Minister, survives this as a result, and we could be looking at a general election coming up in the weeks or indeed even months ahead, because this is an absolute shambles of an economic policy in such the early portion of a prime minister that, it has to be remembered, was not elected, but actually only put into power as a result of vote within the Conservative Party that she had. So therefore, a general election might be needed to deliver the proper mandate required to put forth the economic changes that are going to be needed to keep the country out of recession. So this U-turn might make for great headlines, but ultimately, JD, I think we're looking at a snap election relatively soon, because I simply don't see how she can survive it.
It's a great perspective and important context there. On to number 2 we go. What do recent changes, Martin, to chip export rules mean specifically for this sector? I know on the screen right now we got a story. There we go. What do recent changes to chip export rules mean for the sector? That's a little bit of a preview for our next one. What do you think on this one here, Martin?
Well, we got another warning on from a chip sector stock itself last night. Applied Materials, semiconductor equipment maker. Basically, they make the gear that helps companies design and make chips. Now, the U.S. government has restricted exports of that kind of technology to China as a result of concern. Firstly, that some of it was ending up with the Chinese military. Secondarily, that it was being used to potentially surveil American citizens. And thirdly, the government simply wants to make sure that it's backing up its pledge to produce chips in the United States as a result of the Chip Sector Act that cost the government about $52 billion. So collectively, those reasons triggered the export restriction. But of course, they're going to have an impact on companies that relied on China-based customers for a significant portion of the revenue. Applied Materials said it's going to cost them $400 million this quarter and a similar amount next quarter as a result. So the stock was off pretty significantly in pre-market trading. It's going to get dragged even further, I am sure, as a result of the CPI data too. But we're seeing those reflections from the chip space across the board, and that doesn't bode well for the sector, which is already facing supply difficulties heading into next year.
Yeah, absolutely. Okay, on to number 3 we go. BlackRock saw its assets tumble in the third quarter. Does this spell bad news for other bank earnings?
This one for me was really interesting, JD. It's always worth remembering that BlackRock is the biggest asset manager in the world. They control, or manage, I should probably say, just under $8 trillion US dollars worth of assets. I mean, that's significantly larger than a lot of countries in the world. And it really goes to show the kind of power that they have in investment making decisions. They saw a solid but not spectacular inflow over the third quarter, even though they were down year on year. But that inflow, JD, was to passive and risk-free investments, a lot of ETFs, a lot of index trackers, that sort of thing. I don't mean to say risk-free, I mean low risk. Obviously, we're not looking at risk-free when we're talking about assets that track the indices. But that might suggest that the trading revenues we're expecting from the investment banks tomorrow could not materialize. And if they don't, they won't be able to offset what we know is going to be a slump in deal-making fees as a result of the decline in IPOs and M&A and everything else like that. So I look at BlackRock and I see the potential for weaker than expected bank earnings tomorrow, and that isn't going to be a help for the indices as we head to the open 24 hours from now.
All right, at number 4 here in our rapid fire section, I admit I opened up this app yesterday. I don't often, but from time to time I do. Number 4, Truth Social is now on Google's Play Store, but for how long, Martin?
Well, that's the question, JD. Ultimately, we don't even know if Truth Social is going to find a financial home. They're trying to do this SPAC merger with a company called a Digital World Acquisition Corp. But because there are so many investigations into its financing from the Department of Justice and from others, they've had to delay the merger for a number of months now. And if they are going to delay it any further, by law, they're going to have to liquidate the SPAC on the 8th of December. They've called the shareholder vote for November. They need 65% approval in order to extend the life of the SPAC, in order to outlive the investigations and potentially execute the merger. But they've had great difficulty in getting to that level because DWAC is funded by a lot of individual investors, and it's been difficult to marshal them all at the same time for that kind of shareholder vote. So Google Play, in allowing Truth Social onto its platform, might not have much of an impact, even though it does suggest that if the deal goes through, Twitter will have at least one rival in the, shall we say, in inverted commas, free speech space.
Absolutely. Okay, that's going to about do it. But actually, Martin, on a rare note here, I'm going to give you one other newsy update back to something we talked about earlier and see if you have any reaction. Barclays now sees Fed raising rates 75 basis points in November as well as December. Is that largely in line with your expectations? There was some chatter. I know this is like whiplash because we're doing rapid fire, but I just got this in. I do want to get your reaction. There was some talk that as we pass November into December and early next year, the numbers might start to peter off. That doesn't seem to be the case, at least according to Barclays, based on the inflation data this morning. Any reaction?
I think they're absolutely right. The Fed Watch suggests that the bets on a 75 basis point rate hike are rising significantly for the month of December. They're a lock for November. There's no question about that. But I just go back to the fact, JD, that 2-year note yields and other metrics that we're seeing in the interest rate market point to a Fed funds rate that will top out at 5% early next year. That's a half a point higher than we expected prior to this inflation data. So even though I was under the impression that the mixed messages from the reading today wouldn't necessarily change expectations for Fed rate hikes, I've proven to be significantly wrong because people are really concerned, maybe based on the Fed minutes and the hawkish tone of it yesterday, that the central bank is going to continue raising rates irrespective of its impact on the biggest economy in the world. And that does point to faster rate hikes. So I think Barclays is probably correct. Ultimately, what's most important is at what level we top out at, probably 5%, and for how long we stay there. And it could be for at least a year. That's not the dynamic from which you can execute a significant stock rally.
Honestly, this is the first time I think in our conversations I heard you say the 5% figure. I know we always float around the 4 to 4.5, and you've made a good point before on this topic to say it matters a bit less what the increments look like. Ultimately, it's more about the landing zone, where we go. And I wonder what today's data, the September CPI figures, are going to say, and if that changes that calculus. Thank you for letting me throw that in there, Martin. It's that type of morning with breaking news, obviously, with big red tape on the board and analysts putting out a bit of updated guidance. And as I get sent it to my inbox, I wanted to get your fresh reaction because, as always, there's no one I'd rather talk to about all of these stories. The great Martin Baccardax. We didn't hit sports today, but it's on the Thursday calendar. I'm sure tomorrow we will because we got football tonight and no shortage of good stories to talk about as the shows roll along. The great Martin Baccardax. Martin, thank you.
Thank you, mate. I'm suddenly a San Diego Padres fan, just so you know.
I wondered. I think a lot of people are San Diego Padres fans. I gotta tell you, man, they looked great in their first round, and it's the sort of team where like a lot of people are going to be watching maybe for the first time, be like, yeah, I really like that team. So I know you're not alone on that. Enjoy the playoffs, enjoy the game tonight, and we'll do this again tomorrow. That's going to do it for a very busy and breaking news edition of Market Open here from the floor of the NYSE. Stick with The Street for more on these and all of the major market stories that matter to you. We'll see you tomorrow.